I would say 85-90% of the family offices that exist probably shouldn't exist as they currently do.
Welcome back to All Star Podcast. I'm very excited to have Ron Diamond as a guest today. Ron is an expert on the topic of family office. He's the founder and chairman of Diamond Wealth. He invested alongside over 100 family offices, ranging from $250 million to over 30 billions. He's a TED Talk speaker and he taught at universities including Harvard, Stanford, Oxford, and Chicago Booth about family office. Before entering the family office world, he founded Pinnacle Capital, a $250 million hedge fund that outperformed the S&P for a decade. He started his career at Bear Stearns and graduated magna cum laude from Northwestern University with a degree in economics. I'm so excited to get started. Let's jump in. Ram, welcome to the show.
Thank you. Pleasure to be here.
Yeah, I really appreciate you being here. So I know you are a family office expert. Before we dive deeper, can you help us understand the definition of family office?
So that's a great question. I'm going to start by I keynoted a conference at Stanford maybe 5 years ago, and
Hmm.
I had five multi-billion-dollar family offices on the panel. And I asked each one of them the exact same question you're asking me: what's a family office? And I got five completely different answers. And nobody was wrong, nobody was right. It's just that's kind of where we are. It's the term family office is used over and over again, and it means so many different things. The problem right now is that the whole family office model, only 25% of family offices make it to the second generation, and 10 make it to the third, and five make it to the fourth. And it's very fragmented, very inefficient, and siloed. So when you ask what is a family office or what should a family office be, they're two different questions. Because when you say what is a family office, a lot of people they'll sell their widget company for $100 million and they'll start a family office. Well, that's not enough money to have a family office. In order for it to make economic sense to have a single family office, if you're going to invest in the private markets, you need a bare bones minimum of $500 million. If you have a deal team. Could probably do a little less if you're just investing in the public markets. There's a lot of people who have less than $500 million who have a family office. And again, I don't judge anybody. I'm just saying that objectively, what they should be doing is they should be going to a multifamily office. So if you have between 10 million and 250 million, that's what the multifamily offices were meant for. 500 million on up, that's the minimum you need in order to have a single family office. And the point of a single family office, what it's supposed to be, is supposed to have somebody's had a liquidity event. It's supposed to last generations. You're supposed to be able to put your family in it. And in addition to growing the capital, growing the assets,
Mhm.
you're also supposed to philanthropy, governance, succession, next gen, all of these things. So it's kind of a vehicle where everybody is together, and the goal is basically the product is the money of you're not selling a product. The product is the cash that you have, and you're trying to take that money, move it downstream from generation to generation, and instill values so the model works. Right now, this is a really, really inefficient, fragmented, siloed market, which we're trying to fix.
Got it. Why do you think many family offices choose to stay as a single family office? Is it trust? Is it operational efficiency? Like, why do they do that?
Ego.
They wanted to say that I have a family office instead of being with a brand.
Yeah.
And is there a fix to that?
Yes. Realize that, look, at the end of the day, first of all, I don't judge anybody for anything. I mean, if you sell your widget company for $25 million, that's a lot of money, and that's kudos to you. The problem is that there's no playbook for family offices, right? What we're trying to do, I put together a family office initiative at Stanford, and I helped to put one together at University of Chicago Booth. We need to get this right, because right now everyone's got a family office, right? I would say 85-90% of the family offices that exist probably shouldn't exist as they currently do. Having said that, initially, the Medici were probably the first family office. Goes back to Europe thousands of years ago. But I would say that the Vanderbilts and the Rockefellers were really the first
Mhm.
family offices in the U.S., and they started in the late 1800s. But here's the issue with this whole family office phenomenon: 68% of family offices were started since 2000. Half of them were started since 2008. It's a new industry. There is no playbook. Every service provider, every bank, everybody who's trying to get into real estate or trying to sell a fund is trying to get that's where all the money is.
Yeah.
You currently have $10 trillion in capital. And just to put that in perspective, You've got 6.5 trillion globally in the entire hedge fund universe. So today, the family office market's bigger than the whole hedge fund universe. But here's really what's key. In the next 20 years, there's $124 trillion that's moving downstream from the baby boomers to the next gen. In other words, this is going to be the largest transfer of wealth in history.
Yeah.
So what's going to be big is going to be massive. This will be larger than private equity and venture capital. So you've got huge amounts of money in very inefficient hands without a proper playbook. And what happens is people from Silicon Valley, they sell a tech company and they have a liquidity event. They sell their company for a couple $100 million. They start investing. That's the last thing you should do. The first thing you should do is something called governance. Most people don't even know what governance is. The second thing you should do is talk to an estate planning attorney. That's like the foundation of a house. Without it's not fun to talk to the estate planning attorney or to build. It's not fun to watch your basement being built. But if your basement isn't built, your house is going to crash. So you need to get that right. Then you need to deal with succession and next gen and governance and family dynamics. Once all of those have taken place, at that point, you can start investing. But that's never what happens. And that's part of the reason that the, the model only 25% make it to the second gen.
It's got the governance. Yeah, that makes sense.
It's governance, it's succession, it's next gen, it's family dynamics, it's investing rather than talking to an estate planning attorney. It's ego. There's a whole bunch of things at play right now.
We'll get to a lot of them. But before we dive into specific factors, I would love to understand: do they behave differently based on their size, their source of wealth, or their founder personality? Is there a way to segment the market?
For family offices, no. You've seen one. They're all different. And everyone's looking for different things. So some people have sold their company for $500 million and they're looking to grow it to 10 billion. Some people have sold their company for $500 million and that's more money than their great 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 grandkids will need and they're looking for wealth preservation. Some people are very conservative, some people are very aggressive. So it's different for everybody. There is no normal. There is no playbook for a normal family. There's no such thing as an average family office.
Okay, interesting. Do you have any stats on the family office's performance compared to professionally managed private equity, venture capital, real estate funds?
Okay, so let's unpack that. It's a great question. So there are no statistics because you can go to PitchBook and you can find out who are the top 100 private equity firms from 1 to 100. And the same thing with venture capital. You can't do that for family offices, and family offices don't have to report and they keep it private. So there's no readily available information from the family offices. So you don't have that. I think that there are the 10% of the family offices, the Pritzkers, the Crowns, Gates, Dell, Balmer, Sophisticated, Waltons, they do in general. And again, it's relative because everyone has different agenda. But in general, that is a better model than investing in private equity and venture capital funds. And here's the reason why. And
Hmm.
this is only for a very small segment who has a right team. Today, what happens is a private equity firm buys a tech company in Silicon Valley, and when they buy it, I could tell you when they're going to sell it. It's not because I'm so smart. I just said I know how they're compensated.
Yeah.
Charlie Munger said, "Show me the compensation, I'll show you the result." They're going to hold it for 5 years. Typically, sell it. They're going to sometimes sell it to a strategic, but oftentimes sell it to another private equity firm. So what happens is over the course of 20 years, this one company is going to probably change hands, let's call it 4 times. If you look at the taxes and the friction and the disruption in business versus a family office who could simply buy it, hold it, and let it compound, the results aren't even close. It's objectively a better model. The
Mhm.
problem with the industry right now is that even though it's a better model, very few family offices can execute because they don't know how. And that's what we're trying to do. We're trying to put together a playbook to do that. The biggest advantage that family offices have is something called patient capital. So
Mhm.
there's no shot clock. You shouldn't have to sell a company in 5 years just because that's how you're compensated. So you've got huge amounts of capital in very inefficient hands in general. Those that have institutionalized it, the ones, the Pritzker, Browns, Gates, Balmer, Dell, those ones, they can compete and have actually objectively better model than KKR or Apollo or Blackstone because they don't have an artificial timeline. My feeling is that as private equity and venture capital disrupted the public markets in the late 80s, when it first started out, it was a better model. 2% covered the overhead, 20% I make money if you make money.
Yeah.
happened is that it's much more so in the private equity space, but certainly in the venture capital space too. It's become an AUM game. And these funds, and that's where they're making their money. You're supposed to make your money on the 20%, not on the 2% management fee.
Right.
So what happens is, I have a good friend who did a roll up of logistics companies. He needed $150 million placement. He had a phenomenal track record. Placement agent got him 500. He said, "That's great. I just need 150." Placement agent literally comes to his house in New York and writes down 2% of 500 million equals X, 2% of 150 million equals Y. What am I missing? So my friend's a bit incredulous and looks at him and goes, "Here's what you're missing. If I do what you want me to do, there won't be a fund two because I can't deploy the other $350 million." That's a microcosm of what's wrong with the private equity industry in general. Now I'm generalizing, but that's
Yeah.
in general. That's the problem. It's become an AUM game.
Yeah. I mean, if you could have the AUM pay the bills and pay the growth.
But that again, it was supposed to be the 2% was supposed to cover the 2. You have 2% and 20%. 2%
Yeah.
was supposed to pay the bills, but they realized if you could get a $5 billion fund and you're getting 2% every single year as an annuity, for the GPs, it's a good business model. It's not a good business model for the LPs, and what it does, it forces them to buy things that they don't necessarily need to buy. They have 2 options. They could either give the money back, which they'll do 0% of the time, or they can invest the money in overheated markets, which they do. In pre-COVID, we saw a lot of situations where we were gonna buy a company, and I had a syndicate of 12, 15 families, and we were gonna pay
Mhm.
X, and private equity firm came in and paid X. Now, there's no way objectively it was worth that much money. But again, they have 2 options. They've already got the money. They could either give the money back to the investors, which has never happened as far as I know, or they can invest in overheated markets and overpay. And that's basically what's happening. So I believe that the family office model, I think that as private equity and venture capital disrupted the public markets in the late 80s, I think family offices are going to disrupt private equity and venture capital. It's not going to replace it, but it's going to certainly disrupt it for those very reasons.
Interesting. So, how involved does a family office investor once they get into the deal? Are they operating or are they more a passive allocator?
Again, it's a great question. It's all over the place. Um, some families, it depends what they have on their deal team. I mean, if you've got the sophisticated families like the Pritzkers, the Crown, Dell, et cetera, they've got a deal team and they manage it and they manage it and they operate. So the problem also with a lot of these private equity firms and even venture capital firms, many of the people of these firms, they're finance guys. And I'm a finance guy. I mean, there's nothing wrong with that. But in order to create alpha, you need to operate. And family offices they did something, they operated something. So I think that that's one of the issues. And in order to, like I said, when you look at these private equity firms, it's not all of them, but many of them. I could financial engineer any company and make a profit 3, 4, 5 years. I don't know what's going to happen after that. But in order to create something that's going to last 20, 30, 40, 50 years, and grow the business, you need to operate. And that's what a lot of the private equity firms don't do. Some do, but most don't.
Yeah. And how does the investment typically come together? For context, your network is a lot of family offices coming together. Do they evaluate deals as a group or do they evaluate deals individually?
What I have is I have a syndicate. We about 130 family offices, and these are families between 250 million to 30 billion. And we invest together in the private markets. That's private equity, venture capital, real estate, sports teams, credit, special situations, et cetera. It's not a business. I used to run a hedge fund and I sold it. And it's a way. So what I do is I do it. I'm not doing it for self-list purposes. I do it self-ishly because I don't have enough capital to invest $100 million per deal. Now I
Mhm.
do. So I call it first call alpha. So basically, I know who likes what. So if it's an early stage venture, of the 130 families, there might be 18 that like early stage venture. If it's your world, real estate, there might be 92 that like that space. If it's healthcare, there might be 46. So I kind of know who likes what. If they want to come in, great. If they don't, that's fine too. We could structure an SPV. We could structure however we want. And it's been very effective because I call it first call alpha. Oftentimes now we are the first call. And a lot of the deals we're getting come directly from the large family offices. They might take down $200 million of a deal. They have 50 left over. We'll take the other 50. They've already negotiated incredible terms, better than I can negotiate myself. So that's the model that we use. We basically aggregate I aggregate with other family offices, so we have more capital, so we're the first call, and then we get better terms. And a lot of times we can be part of the GP as well.
Yeah, that makes sense. And you will do the diligence on behalf of them?
Yeah, so again, I do the diligence, and I've got a team of people who help me with that, but again, a lot of the diligence, because most of the deals we get come from these big family offices, they've got a deal team of 60, 65 people. They've done the diligence. They just said, "Hey, we're taking 200 of this deal. We've got 50 left over. Do you want it?" The diligence is we'll do more diligence, but, 90% of the diligence has already been done.
Makes sense. Yeah. And when you actually work with a family office, do they set aside like a dry powder to pursue opportunities like to find new investment opportunities that are compelling, or do they usually reallocate some of the existing positions to get into new ones?
What do they do or what should they do? They're 2 different questions. Again,
Let's say, what do they do?
well, right now, here's the problem that right now, personally, I have a ton of money that's going out. I have very little money that's coming in, and that's true. If you're investing in private equity or venture capital, you're not getting a lot of money coming. You're getting capital called, but you're not getting money coming in. So there's a liquidity issue. And so right now, how do you manage the cash flow? And they don't do it. So I think what's interesting is because I use Ty Warner as an example. Ty Warner was a brilliant businessman. He had Beanie Babies, which was a brilliant business guy. I mean, a brilliant idea. Sold it for a couple $1,000,000,000. Then he tries to buy the Four Seasons Hotel and gets killed. Because you're good at something doesn't mean you're good at everything. So I ran a hedge fund. I'm fairly good at that. I'm horrible at a lot of stuff. I'm bad at more things than I'm good at, right? But what happens is, and this is where the ego comes in, you sell your company for $1,000,000,000, you think you could do everything. You can't, you're
Yeah.
still only good. If you made your money in multifamily real estate, you're a real good multifamily real estate investor. You know nothing about venture capital. You know nothing about private equity. You should outsource that. And that's not what happened. So we need to put together a playbook for the industry. And the problem is that there's so much money involved in family offices, and everybody's trying to get in that for the every service provider, everyone who's raising money for fund is trying to go to the family offices. And they there's a whole new industry, not new, it's been around for 20 years, these family office conferences. Now, we of the syndicate that we put together, they'll say, "Hey," and I'll keynote a lot of these I'm friends with the people, and they're good people. They'll say, "Hey, I see you're keynoting this conference. Should I go?" And 99 times I'm like, "No, don't go." Because it's a pay to play model. So if you're speaking, and let's say you're multifamily real estate, you might be really good or you might be horrible, but I know you spent 25 grand and that's the only reason I'm listening to you. So these conferences now, the family offices don't go to these conferences. It's become service providers pitching to service providers. And family
Yeah.
offices, sophisticated ones, just don't go. What I wanted to do was I wanted to put together a family office conference that I would tell you personally, or I would tell 130 investors that invest with me, yeah, this is a conference you should go to. So I chaired the Disruptive Technology Center, the advisory board at Stanford University, and I put together a family office initiative. This was during COVID, maybe 5 years ago. And I said, let's put together a conference, but let's do this. Let's put together a conference that I would actually tell the investors who invest with me, yeah, this is one you should go to. So I went to Kirkland and Ellis. They're probably best in class. They're certainly one of them for law firms in
Yeah.
EY. And I said, look, you guys do the heavy lifting. I'm not a conference guy, but what I'll do is two things. I will get you world class speakers, and I'll pick the content because I know exactly what family offices should need and want to hear. So I'll give you three quick examples. So the first guy I called was a good friend, Paul Carbone. Paul runs a family for Tony and JB Pritzker. Wasn't pitching a fund. He had no agenda. He was just saying, here's how we do due diligence. We start with 200 companies, goes to 50, goes to 20. I come in here. We have an investment committee meeting. We decide if we want to board. All he was doing is saying, this is how the process of how we do due diligence. There was no hidden agenda and there was no ask. Second example, Tim Callahan, more in your world, in the real estate space. He was Sam Zell's partner. He wasn't raising fund. He made a fortune in offices. He's a great guy. He wasn't raising fund 4 or fund 5. He wasn't raising anything. He was simply
Hmm.
opining on what he thought was going to happen to the office market. Because remember, during COVID, people didn't know if people would ever go back to offices. And he was just giving his opinion.
Right.
No ask, no agenda, just like a thought leader. And he was pretty much spot on everything he said. And the third example is Denise Illich, who's a close friend. They were Little Caesars and a couple sports teams. She, along with Dan Gilbert, helped to rebuild Detroit, right? She wasn't asking people at the conference to donate to her charity to make Detroit a better city. She's just saying, "Look, I don't care what your philanthropy is. You need to run it more like a business. And here's what we got right. Here's what we did
Mhm.
wrong. And here's what you need to do." No agenda, no ask. 880 families from 6 continents on a Zoom call, 410 over $1 billion on a Zoom call during COVID on a family office conference. It was like tenfold what Kirkland or EY expected. I had no idea. I knew it would do well. I didn't think it would do that well. But the point is that there's a huge demand for knowledge and content. And where do you get that? And I think that the conferences, and again, I don't judge anybody. Everyone has to make money. They make their money by getting sponsors to pay to speak. So the only way this can be done, in my opinion, is to do it through a university level, right? So I did it at
Mm.
Stanford. And then 3 years ago, I'm having lunch. My first boss was Michael Milken, and I used to work at Drexel Burnham. And I'm having lunch with Michael Milken and Stephen Kaplan, who top professor at Booth. I said, "Look, here's what we did at Stanford. Let's put together a family office initiative at Booth." And he
Yeah.
said, Paul Carbone, who's also a good friend, said he wanted to do the same things. The three of us kind of whiteboarded together. This was maybe 3 years ago. And what we did, and this really the only way that I think you, because we don't have to make money, we don't have to make a profit. So what we
Right.
did is we put together a course at Booth. You need to be a full-time MBA student. We called it Family
Uh-huh.
Office. We had no clue how it would do. Thought it would do fairly well, but we had no idea. Because right now the top kids out of Booth or Wharton or Stanford or wherever you call it, they want to get in private equity or venture capital or real estate or
Yeah.
hedge funds. Nobody wants to get into family office. They don't even know what a family office is. With $124 trillion moving downstream from the baby boomers to the next gen in the next 20 years, I'm correct. I could be wrong time wise, but I'm right directionally. At some point, be it 3 years, 5 years, 7 years, the first choice of these kids out of these top schools is going to be to work for a family office. So we did a half a credit course. It sold out instantly. We had no idea. Sold out quicker than private equity class, which was fantastic. Professor Heaton was the main teacher, terrific teacher. I taught one of the classes. The class that I taught, um, there are 65. I just said, "Hey, if anyone's interested, has any questions," I gave my email address. 48 of the 65 emailed it, and nobody was asking for a job. They're just saying, "Hey, I got a job at this private equity firm. I heard what you said about patient capital and family offices. Is it too early to do?" So there's huge demand for this right now. And now we're going to do a full credit course, right? The conference we're doing, similar to what we did, we don't have to make money. Tony Pritzker donated $5 million for the naming rights for the professorship. And then we've got somebody else donating $30 million. It'll be the so and so family office initiative at University of Chicago Booth. So we don't have to make money. So the people who are speaking are Nobel Prize winners from Booth talking about geopolitics or tariffs or interest rates or behavioral economics,
Mhm.
family dynamics, things like that, without an agenda. So this has to happen. So when I announced what I was doing at Booth, I got called from MIT, from the assistant dean at MIT, and then Kellogg. There were about a dozen schools that reached out because, in my opinion, today Booth is the only place that truly has this. In 5 years, maybe 7 years, every top business school is going to have a family offices program because they need to, because that's the trend where everything's going.
Yeah. And did you have to design the curriculum and create the content?
I didn't personally, and we didn't know how. I mean, Professor Heaton did most of the work. I mean,
Uh-huh.
we Paul Carbone and myself and a few other people put in some thoughts on what we thought would be important, but it was kind of a trial. But what we found
Right.
was there is huge appetite. Like everyone, all these, I call them kids, all these students, they know it's opaque. They like, it's like they want to be a want they want to get money from family offices. They want to be a family office someday, but they don't know what a family office is. So there's
Right.
huge interest in it, but there's no knowledge. And what we're trying to do is to create something, a vehicle where these tech entrepreneurs who sold their tech company for $500 million, now they've got a playbook. And the playbook says this: you sell your company for $500 million. The first thing you do is find an estate planning attorney.
Mhm.
That's the structure. The second thing you do is find somebody to help you with governance. The third thing you do is deal with succession and next gen. Then you deal with family dynamics. At that point, maybe 6 to 12 months, then and only then can you start investing. And you have to have an investment philosophy. You have to have a mission statement for the investments. That almost never happens. That's what we're trying to change.
I have a question. So, do you think family office tend to reinvest in the same industry where they made money from, or they normally diversify away from that concentration?
Okay. They should, but they don't. So again, and it comes back to ego. I think, I'm fairly good at running a hedge fund. You're pretty good at real estate. I'm not a venture capital guy. You probably wouldn't be great investing in a sports team. What should happen is you made your money in real estate,
Yep.
focus on real estate, outsource the rest. You made your money in venture, fine. Your tech, do tech, outsource the rest. All I do is I surround myself with people that I trust implicitly, and that's huge, that are smarter than me in various verticals. What happens is a lot of these families invest outside of their own expertise, but they shouldn't. And that's again something that's going to change. And that's another reason why the family office model is broken. So what you should do is again, you make your money in tech. You're a tech guy. Everything else outsourced to people that you trust and are best in class in what they do. It's not complicated, but there's no playbook. And this is happening so fast. I mean, there are, again, 10 trillion in capital and 24 trillion moving downstream. And it's a new industry and it doesn't work.
Yeah, makes sense. You mentioned like family office conferences. I've been to actually one of those. Too. Yeah, as you said, there's a lot of service providers trying to raise money from each other. My question is for people who actually have good deals, some people have really big dreams and they are well deserved to have funding. What's the access point? Where should they look?
That's a great question. Well, that's another problem because right now, family offices aren't going to these conferences because they know it's a pay to play. So if you've got a great idea for a great real estate fund or private equity fund, I would not necessarily tell you to go to a conference because at these conferences, it's basically service providers pitching to other service providers. And if there's a family office or two there, everyone swarms onto them. It doesn't work. The model doesn't work. What should happen, and again, we're trying to. This is an industry that's really in its infancy. What should happen is if you're really good in real estate, you should know these 50 families invest in multifamily real estate, and they like to do A-rated, A buildings and whatever the class is. But the problem is that right now, how do the smart people find the rich people, and how do the rich people find the smart people? They don't. It's not going to happen at conferences. Now, at Booth, we put together a conference. We have 175 families, so yeah, that, but we won't let service providers into that. What needs to happen is we've got a couple families we work very closely with. These are multi-billion-dollar families, and what they do on one piece of paper, here's what they do. They say, "We invest in private equity, real estate, and venture capital." In real estate, our average size check is $10 million. We need to be majority. We don't need to be majority. We need a board seat. We don't need a board seat. We invest in multifamily and student housing. We don't touch industrial. We don't touch office. In private equity, this. In venture capital, we do this. It's on one piece of paper. It's incumbent upon us, the family offices, to do that. If they
Right.
want to compete with the Carlyles or Blackstones or KKRs, they have to do it because if you want to invest in really good real estate deals, you need to know people who are really good in real estate. They should know that that's what you invest in. Otherwise, it's a complete waste of time. And the problem is that it's such a fragmented industry and siloed and inefficient that you're looking to raise money, let's say for a real estate, you might know one or two family offices who invest in real estate. You should know 50. You should know 100 of them. There should be some sort of area where you could find the platform for it. And the family office, though, they don't even have to use their name. They could say, "I'm family office X." But
Yeah.
family office X, then if you've got a multifamily real estate deal and that's what they invest in, they should know that and you should know that. That doesn't exist either. Another thing we're trying to do. So again, it's a heavy lift. It's a new industry that doesn't work. It's broken. But that's another thing. The other thing that has to get right with family offices also is compensation. Like most family offices today, if they pay a kid out of Stanford MBA 250,000, not all, but most of them look at that as a cost. In other words, that cost me 250. I
Yeah.
can promise you, if Carlisle or Blackstone or KKR or Sequoia or NEA pays a kid 250,000 out of Stanford. They don't look at that kid as a cost. They look at that kid as a potential or student as a young adult, is a
Yeah.
potential $20 million profit center, right?
Yeah.
It's not a cost, it's a profit center. It's another thing family office have to get right. So there's we're I used to think we're in the third inning, then sometimes I think we're in the now sometimes I think we're in the first inning. It's evolving, but again, it is gonna happen because 124 trillion is not a fictitious number. That money is coming downstream from the baby boomer to the next gen. We have to get it right, and it's just so broken right now. So at some point, family offices are going to become more professional, more institutionalized, and those that are a dream to work with. They're great partners. They operate. They don't have a chat clock. They're partners. They've got a network of people. That's what you want. That's where this industry is heading, but we've got a ways to go, and there's a whole bunch of work we need to do, and that's one of the things we're trying to solve for at Booth.
Yeah. That's wonderful, and thank you for the summary. And so you personally built a very big network with family offices. Sending cold emails doesn't work. So how do you get started?
How I got started was, when I ran a hedge fund in the 1990s.
Yeah.
Um, they didn't call them family. They used to call them rich people, and now they call them family offices. That's how I got into the space because I had a bunch of my clients who were rich, and now they were actually family offices. That's how I got into the space. But for somebody who's trying to enter the space, who's got a great idea in real estate or a great idea in private equity or venture capital or technology, it's very, very hard. Most people probably know 2 or 3 family offices, and you could talk to them and then get network with them and then see if you could do. I mean, one of the problems also is that everyone's trying to get, like, these people you're raising $200 million, you see these family offices as a dollar sign, and they're trying to get the money. What you should do in to look at it, figure out a way to give something first. In other words, how
Right.
do you add value to them? Now, how do I add value to a $50 billion family office? Well, I do, and here's what I do. I'll introduce them to other family offices, right? If they
Yeah.
made their money in real estate, I'm not going to be a value add by saying, here's a great real estate deal. They'll know it better than I did. But what happens is if you're right now, if you're a family office, you have to understand that this industry is where it's going, where it's heading, and the trend that it's going towards. And I think that once we get it right, and we're a long ways from there, but I see a light at the end of the tunnel. And I could tell you that objectively, it is a superior model to private equity or venture capital. But these people who are looking to raise the money, they don't know where to find them. So it's not incumbent upon the smart people. It's incumbent upon the rich people to say, here's what we look for. And that's what we have to do. So I wish I had a silver bullet for you, but I don't.
Yeah. You are a public speaker. You have a platform to, as well to talk about family offices. What questions that you wish people to ask you more, but you don't get asked?
A, should I have a family office? B, why do I want a family office? I mean, a lot of it's interesting. A lot of the family offices, it, I don't know, they say roughly 10,000 family offices, but who knows what the actual number is. It's not that there's 10,000 families that love to manage money. It's driven by ego, but it's also driven because they don't trust Wall Street, right?
Yeah.
So a lot of these family offices, like these big wirehouses, they're not even fiduciaries. Like they don't have to do what's in your best interest. Think about that. The biggest firms are not fiduciaries. That's why RIAs became important because they're fiduciaries, and then multifamily offices became. So you've got so many different issues, but it all comes back to alignment of interest. And these family offices, again, a lot of why it's not that they love investing or they're even good at it. They just stop trusting people. Intelligence is a commodity. There's a lot of really smart people. Integrity's not. And that's something that people really understand. In working with family offices, the first, second, third thing a family office, let's say you got a great real estate deal. Okay. The first thing, second, third thing a family office wants to know is, who are you as a person? Can I trust you? What's your background? Let me have references for you, other people you've worked with.
Mhm.
That's flipped institutionally. It's not relationship. They're going to say, what's your 1, 3, 5 year track record? What's your biggest drawdown? and then they'll do a little diligence on you as a person. The difference is that family offices, it's a relationship business. And what a lot of people who are looking to raise money from family offices don't understand is they're going to come in and say, well, I just earned 40% IRR in this last fund and I've got a great track record for the last 10 years. And perhaps they do. And it's obviously better to have a good track record than a bad track record. But that doesn't mean a family's going to invest with them. They need to know them. And in order to know them, they need to trust them. And in order to trust them, you have to figure out a way to add value to them. So it could be a family office who made their money in real estate. You see an interesting article on real estate, you forward some interesting articles without an ask. We live in a society where everyone is looking to get and not give. I think that if you take a longer term perspective and you give before you get, really good things happen. I can't explain to you why, but the more I give, the more I get. It doesn't make sense objectively, intellectually, but it's true.
Okay, great. So I have some rapid fire questions
Yeah.
that at the end of the conversation, I would love to get your thoughts. Some of them are either or questions, so whatever comes to your mind first, then just tell me and you can add a little bit context. So my first question is, what's the edge for family offices? Is it that the deal access or their judgment?
It's flexible and patient capital. The biggest advantage that family offices have is there is no shot clock and their interests are better aligned, and it's patient capital.
And what's their preferred vehicle? Is it directed deals or fund?
It depends. So, what happened is post crash. This is rapid fire, but I'm not going to give you a rapid fire answer. Post crash, pre COVID, a lot of people bypassed the funds because post crash, pre COVID, if you invested private equity, venture capital, real estate, Bitcoin, the stock market, everything went up. Families are like, well, why do I need a guy like you who's really good in real estate if I can make money and I don't have to pay you your fees? Well, they were right until they were wrong. And then 3 years ago, they jacked up interest rates, and all of a sudden now these family offices are underwater. So some of them, I think a lot of them are now going back to the funds. Now, you can invest directly if you made your money in real estate. Yeah, you can invest directly in real estate. If you made your money in tech, you can invest directly in tech. But it's all over the place right now. And again, it just it's chaotic right now. Now the large ones who've institutionalized it, again, this is the trend, what's gonna happen. If you're looking for something that's gonna, let's say you got kids in the business or you've got members of the community that are in the industry, mm, and you're looking for this to last 20 years, you're almost always gonna be better off at the family office. They're not gonna give you the highest dollar price today, but over 20 years, it's almost always gonna be a better result if they have the ability to execute. And if they do have the ability to execute, that's where you wanna go. And I think that's going to be a trend that's gonna continue.
Great answer. Yeah. At the end, I would love to ask where can our audience find you and learn more about what you do and learn more about Family Office?
So I've got a, media company, familyofficeworldmedia.com. I on that, and then I've got a newsletter. I'm fairly active on LinkedIn, and, it's hard, I can't obviously return everybody's phone call, but, on either reach out to me on LinkedIn or, for a lot of the podcasts we do and webinars we do, are online, so they could see that, and through my media
Sounds
company.
great. Thank you so much for the time today. And I personally really learned a lot about Family Office. It's a very big world, a very diverse world, and you shed some light on it. I'm sure that with your work, that it's going to be more professionalized and institutional standard, and we're all going to benefit from that. And thank you for the work you do.
Thank you for having me.
Really appreciate it.